Hey there, everyone. Happy Friday, May 16th, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a pretty gorgeous, overcast, cool, but quite comfortable Redmond, Washington. Hope you guys are all doing very well wherever you're at around the world. Thanks for tuning in live. Those of you that are doing so, we are going live here on Friday. Had a number of things I was going on. A lot of times I like to record this show a little earlier in the day to get ahead of a number of other things I have to do on Friday afternoon. But boy, the timing just worked out. So here we are. By the way, just released the latest episode of our Market Misbehavior podcast, and it's a really good one. Gary Antonacci is the author of Dual Momentum Investing, which is one of my recommended reading books that I suggest to anyone who's starting to learn about trend following or momentum investing. And I was able to connect with him virtually yesterday. A really fun conversation. This is someone who, started in the industry, working with like Bob Farrell at Merrill Lynch, Richard Donchin, who did some foundational work on channels and breakout strategies, worked with Richard Dennis, Paul Tudor Jones. Just a really fun conversation. Not the last I hope I will have with Gary on the podcast, but it was a really cool one. So look at that on our YouTube channel. Earlier in the week, we had Nick Raich, who's an earnings expert from the Earnings Scout. Really good discussion about earnings trends in the Q1 earnings season and a unique way of looking at earnings estimate revisions. So some great content on there. We got a lot of really good guests lined up here in the weeks and months to come. So keep tuned in there. We'll do a brief market recap here on Friday. And sorry, I just didn't share my screen, so that's helpful. Let's get there. There we go. Looking at the major averages, we're going to do a brief market update. I'm going to spend a little more time preparing for our weekly flight plan with our Market Misbehavior Premium members, where we go through a lot more of the details and some big takeaways from the week. But just to debrief briefly on Friday's episode or Friday's action in the markets. Just a consistent upswing today. Besides 10:30 to 11 a.m. Eastern, which is a bit of a pullback, the rest of it was pretty much a lights out uptrend. The leadership, not what you'd want to see if you're all bulled up. And that's the same thing we talked about yesterday on the show. Defensive sector starting to bubble up on the top of the list. Healthcare, which has been absolutely clobbered earlier this week, starting to regain a little bit of a mojo. Utilities, REITs at the top of the list as well. So this was a good up day, and the S&P and the NASDAQ and even the Dow were up, but it was not a growth over value, Magnificent Seven dominating kind of day. This was more of a lot of things going up, breadth pretty good, but defensive sectors doing better. Really suggests, at least the last couple of days, at least some subset of the investing community starting to get a little more defensive and bracing for some sort of tactical pullback. Potentially, we'll see how things play out here. So the S&P 500 finishing just around 59.58. That's up 0.7% from yesterday's close. The NASDAQ Composite up 0.5%. The Dow up the most, about 0.8%. But mid caps actually doing better than anything else, up about 1.1% today. The VIX continuing to drift lower. So we're in a low volatility environment. I posted on social media earlier today just a general way of thinking of this market, right? A bull market, right? When you think about bullish price action or bullish activity in the market, bullish market sentiment, what does it look like? Three kind of general things, right? At least in recent history. Number one, price momentum, strong price momentum. We have the RSI pushing towards the overbought condition. Might have become overbought on the S&P today, by the way. Improving breadth conditions or strong breadth, right? Suggesting that most stocks are participating and it's not just a smaller group of things that are actually getting it done. And then low volatility, right? The signs of fear are non-existent, or certainly, as much as you think there could be reasons to fear, the market's not telling you. It's pricing in a lot of negativity. And what's great about thinking of it in those three terms is because I think it should be very straightforward to identify when those all change. You look for the VIX to turn higher. There's your, increasing fear, uncertainty. You look for breadth to deteriorate, ideally in some sort of like divergence, which would be a higher price move on weaker breadth. And then you look for momentum shifts. You look for signs of distribution. You look for distribution volume, those sorts of things. for now, market moving higher until some catalysts suggest it goes down. And we've had plenty of headlines creating catalysts previously, but headlines this week have not been weighing on the markets too much. Let's check in on some of the other asset classes. Bonds drifting higher today. So stocks, bonds, the dollar, all going to the upside. Interest rates continue to pull back. The 10-year point finishes around 444. Make a wish. And the long bond yield right around 4.9%. Commodities generally moving lower. Crude oil prices actually pushed up a bit if you look at the USO, but gold and silver back in the red. Copper prices back in the red. Natural gas in the red. This is after gold bounced off the 50-day yesterday. See if it's holding the 50-day here as we go into the weekend. But again, gold's certainly on pullback watch, and we'll see if it turns into something more significant. Cryptocurrencies, Bitcoin is literally almost exactly flat. We're talking about 70 cents on something trading in the 103,000 range. That shows you how much of a non-day this was in terms of the general choppy move that we saw. This is after rallying, yesterday, later in the day. So we basically have rotated right around 104,000 through the course of the equity session today. Most of the top 10 coins finishing in the green. Looking at sectors, so again, what we saw Thursday and then echoed today, healthcare number one, up 2%, utilities, REITs, consumer staples. Those are the four defensive sectors at the top of the list. Energy, the only sector in the red. Crude oil prices continue to disappoint, I feel like, from a technical perspective, so not enough to really get excited about that yet. Technology, second from the bottom, just up slightly. Looking at the breadth conditions, you can see a pretty decent breadth day, particularly with the S&P. Stock charts are saying 89% of the S&P were up today. That's a pretty big number, right? I mean, that's impressive. It's almost a 90% up day. That's pretty bullish. I mean, it doesn't usually happen in bear markets where you have that sort of polarized breadth conditions. With the with the NYSE, which is more of a broader universe, about a 2-to-1 ratio, stocks up versus down. So overall, doing in there okay. Looks like our market trend model will be bullish for the S&P 500. Looking at Magnificent Seven stocks, Broadcom pulling back a little bit. Not sure if that's breaking our trend line support that we've been talking about. I mean, almost exactly, right? We extend this line just briefly. We'll see if it's there. I mean, no, it's not quite there. I mean, it really depends on where you draw the trend line, but we're sort of still remaining above that really steep trend line there. Meta down about 0.5%. Apple flat for the day. On the upside, Tesla continuing to be the most impressive chart out of this bunch this week, although Netflix the only one making new all-time highs here. So sort of a nice update on Friday with decent breadth, actually very good breadth. Cryptocurrencies, particularly I'm looking at Coinbase making a new swing high again today, up another 9% today. So certainly some names moving on the upside, but I think healthcare rebounding on Thursday and Friday, arguably one of the key sort of uncertainties in this market, getting a little less uncertain. All right, shall we get to the questions? We had some really good questions from you guys this week. As a reminder, Friday we like to do a mailbag episode, focus on some of the questions that we didn't get a chance to answer live during the week. Spend a little more time digging into some of these great questions and sharing some thoughts with all of you. Let's get to question number one. Dave, what is the definition of a follow-through day? I throw that phrase around often, and I'll tell you what I generally mean by it. Basically, what I mean, this comes from, it really comes from most of my mentors, at least a number of them, right? John Murphy, who I really did not work with directly a lot early in my career, but his book was the first one I read, and I still think of him as the foundational expert that helped me think about the markets from a technical perspective. He had, we would talk about follow through, right? When you have any signal, that moment isn't enough. It's about what happens after, right? That day after, you get an additional move in that direction to sort of validate the move. Larry Williams, who I've worked with more and more through my career, at times, has a similar concept of follow through. Tom DeMark, who I worked with early in my career, would talk a lot about follow through, but it was more, specific. It was more, we need to move 1 or 2 ticks higher if you have a breakout, and more rules based ways of thinking about follow through. But generally those, some of those key mentors that helped shape how I think of the markets, they all had this idea that once you have any move, right? And like, I mean, we'll look at Coinbase, the chart that I just threw up here a minute ago, right? When you have like that breakout above the 200-day, it's not enough to just have a 1-day move, right? It's not enough to like close through the moving average and then that's it. You need another push. You need some validation, because what happens a lot of times, there are whipsaws when you look at charts, right? There's a big move. We break through a level, but then the immediate next day, you can tell everyone was just kind of waiting for that move, and then they sell into it. And then the next day we move right back. And so to avoid whipsaws or try to minimize whipsaws, you wait for follow through. So when you have a big move, it's like, great, nice move, nice breakout. Let's see if that's validated tomorrow. So I think of any chart as any pattern as having 3 phases. And we did a webcast on this a while ago. There's the setup phase, which is, it looks like the pattern. There's the trigger, which is the thing actually happened. We broke out. And then there's the follow through, or the confirmation, which is, did we move an additional move? Did we take another step? Think of like football. Did we make a football move after we had the breakout? And that last piece, I think, helps minimize whipsaws, right? Minimize false signals. So that's why I talk about that. So that's what a follow through day is. In the general way that I describe it is, anytime there's a big signal, when we break above a resistance level, when we break below a moving average, it's, do we get follow through the next day? Do we get confirmation that that wasn't just a fluke, that additional momentum is happening in that direction? Next question, with hindsight, were there any signals that GLD was going into a correction phase? I mean, I'll be honest, I've had so many questions in this vein recently, with gold pulling back, certainly with the S&P rally. The moment the S&P bounces off the April low, I have people asking me questions about, just everything about, what was that the low? Did we miss it? Is it too early? Is it too late? How did you miss it? You didn't miss it. And with gold, it's like, it's a breakdown. It's not a breakdown. I mean, I think there's a lot of different comments. And I would say a lot of the times that has to do with timeframes more than anything, right? I mean, when I'm looking at the chart of the GLD, I don't see this as a corrective move. I mean, as a correction, right? I mean, as a correction, absolutely not. Because a correction to me implies a much deeper, much more significant, much more drawn out, much more protracted decline. This, to me, when you're pulling back to an ascending 50-day moving average, that seems like a tactical pullback within a medium term and a long term uptrend, right? So the primary trend is still up, but this is a pullback. This is making a potential, higher low within the uptrend. And that's what the market trend model that I designed a while ago was meant to try to codify, which was basically, I want to know, like, something like this: the short term, the tactical model has turned bearish. The medium term model is still bullish. The long term model is still bullish. This is on the GLD. And so it tells me that this little pullback is a pullback within a longer term uptrend. Where you get concerned is where this turns into something deeper, which is the medium term model turns negative, which tells you it wasn't just a tactical pullback that has persisted, and now it's something more significant. So whether you short up here because we failed to make a new high at 315 and you're trying to play this move, or if you're trying to play for years down the road and you're just trying to buy into weakness, we may play this pullback completely differently, right? So I guess the one thing I would say about your question is I would hesitate to call this like a big corrective move. The way that I describe it is sort of a tactical pullback, right? Which to me means the primary trend is still generally higher, but we're pulling back within the context of that uptrend until proven otherwise, right? Until we pull back enough that changes. So to your question, what were signs that we were topping? I mean, I think for me, it's the bearish, candle patterns that, I'm showing a bar chart here. So let me fix that. But basically, you have this sort of bearish engulfing pattern. It's not a perfect one, but you have a bearish outside day. We're at a higher open and a lower close. That's as we tested 315 on the GLD. So that's a short-term kind of tactical signal. Then we basically retested that previous high and didn't get any higher, right? So a bullish phase is a pattern of higher highs and higher lows. And so a bearish phase is the opposite, right? We make lower highs and lower lows. So one of the first things that probably tells you an uptrend might be exhausted is we failed to make a new high. Instead of just continuing that pattern, it stalls out a little bit. Now, were there divergences? Really, not really. I mean, going into the April peak, pretty stable. You can see the RSI was a lot lower in early May, so maybe that's something that I would look at. But again, remember the technical toolkit is there are things that are meant to be more leading indicators, like divergences, like overbought conditions. Things like Elliott wave and GAN are really, I would think of as more leading indicators, trying to anticipate a structure based on what's happened. And then there are lagging indicators. And a lot of my toolkit is more of a lagging toolkit, trend following, not anticipating a shift in trend, but just following the trends when they change. And so that means you wait until the trend reverses. So my goal isn't to pinpoint GLD at 315, although a lot of people think that should be your goal. It's not my goal. It's not everyone's goal, right? To pinpoint and pick the top. It's to recognize when the top has occurred and sacrifice the beginning move for the opportunity to participate in the larger trend. That's the essence of trend following. My interview with Gary Antonacci really goes through what's called momentum investing, which is that style of investing. That's a lot of the ways that I sort of describe the charts and describe the markets through that lens, and that's probably why. Next question. Is there any chart that shows the amount of short interest in a stock? Really interesting question. The answer is yes. Not on stock charts, though. Stock charts doesn't have great data on this, but that's the beauty of having some different platforms you can use. This is Koifin, which is another stock another charting platform that I use. There's a short interest chart here. So this is basically Tesla. And sorry, this is not a chart I normally show, so apologies. It probably looks very different than what you're used to me showing. I usually have this on the other monitor that is not ever shared on the screen. It's where I have other things going, market monitors and news and stuff like that. But this is a 3-year chart of Tesla, and then this is the short interest percent. So the way you usually refer to short interest is as a short interest ratio. Sometimes you'll see data that has like the actual shares that are short. I don't find that particularly helpful. What you really want to know is what percent of the shares, ideally what percent of the float, which is like the freely traded shares, what percent of those shares are currently being used for short positions. So this is saying 2.5% of Tesla's stock is being shorted right now, which isn't that high. That's not a very heavy short ratio. So something like HIMS would probably be a much higher one. Yeah. So this one, you see how it's increased over the last 6 months, right? And now it's about almost 30% of the stock is being shorted. That's pretty aggressive. And so that's how you would think of it. Short interest, and the reason why it's kind of this chunky line, it used to be reported once a month. Now it's reported twice a month from the New York Stock Exchange, if I remember right. So, twice a month you get an official report from the exchange, how many shares are being shorted. And then looking at it in terms of a short interest percent is pretty helpful. That's how I look at short interest on my side. I don't look at it a ton. There are some who look at it obviously way more often, but as I've told, anytime someone asks about something like that, there's only so many things you can look at on a given trading day. So you have to start cutting corners somewhere and focusing on the things that you feel really give you an edge. Short interest is interesting. It's not a central part of my my process. I'm thinking of Phil Erlanger has made a career out of the Erlanger short squeeze. So I would check out Phil's work if you want more information on shorts and what to do with it. Is EWQ, that's the France ETF, if I remember right, over 4210, a reverse head and shoulders pattern. Okay, let's try it. EWQ, is EWQ over 4210? I mean, I'm going to say no, and I think I see what you're getting at. I think you're looking at this as a head and shoulders. Or is it this? It's hard to really tell. Yeah, I'm not sure. I mean, neither of these are great head and shoulders patterns is the short answer, right? So if you're thinking of this as a big inverted head and shoulders, it's not great because there's this double head and this right shoulder is higher than, that doesn't look like a head and shoulders. if it's this, there's way too much of an exaggerated head versus the shoulder. So no, and that is one issue with head and shoulders patterns. It's really easy to look at charts and see them everywhere if you're not careful. There's a book called How We Know It Isn't So, among others, that talk about how we often try to see way more patterns than are actually there. I would look back. I would point you back to the classic book by Edwards and McGee, which is the technical analysis of stock trends. That's kind of my go-to. This one, the Edwards and McGee book. This is really like the Bible of technical analysis, written in the mid 20th century by Robert Edwards and John McGee. All about price patterns and just measurements and techniques and all about that. You can find that at marketmisbehavior.com/reading list, along with a bunch of other books. Here's that Gary Antonacci book that I mentioned, who I just interviewed for the Market Misbehavior podcast. But this Edwards and McGee book really talks a lot about head and shoulders patterns, and I would encourage you to check out the part about volume, because if you're really using that pattern, they were really adamant about the importance of volume through the pattern, and others have written about that as well. But I think that's something I would definitely point you to. All right, we've got some more questions to go through here in a moment, but just to let you know, our next webcast is coming up next week, Wednesday, May 21st, 1 p.m. Eastern, 10 a.m. Pacific. I'll be doing a webcast called Sell in May 2025, Seasonal Strategy or Outdated Myth. There's a commonly held investing strategy to sell in May and go away, to buy back in the fall, to play on the summer doldrums and the weakness in the fall, and buy back later in the year. What we will do is look at some of the recent history and look at some recent years about what's happened during that summer season. And look at a lot of charts about how to think about the current markets relative to those seasonal tendencies. You can sign up for free at marketmisbehavior.com/May 2025. You can scan the QR code that you see on your screen. Either way, it'll get you to a sign up page. Look forward to having you join me next Wednesday, the 21st, 1 p.m. Eastern, for that free webcast. Let's continue. Dave, could you recommend a book for learning Elliott wave theory? Yeah, it's book day. It's a book report day here on Chart This with Dave Keller. So there are two books that I would recommend. Let's see. Neither of these are on my recommended reading list, or I'd point you there, but I'm not a big Elliott wave guy, but I did read a number of books on them. I think they're fascinating. Bob Prechter's the expert I would start with. His book, what was that called? Elliott Wave Principle by AJ Frost, who is a famous Canadian technical analyst, and Bob Prechter. Pretty easy read. Half of it's about like the more esoteric parts of Fibonacci retracements and wave patterns and natural rhythms, but then the other half are all methodologies using the Elliott wave methodology. It's a great introduction to why we look at Elliott waves, or why people do. I found, some of that work is a little too regimented, right? It implies this perfection to Elliott wave analysis, which I found is not the case. So I'll recommend a second book. Steve Poser years ago wrote a book called Applying Elliott Wave Theory Profitably, or something along those lines. And his last name's Poser, Poser. He's a longtime technical analyst, worked for the New York Stock Exchange for a number of years. And Steve's book is awesome because it really focuses on the behavioral parts of wave theory. Why wave one, what it looks like, what it feels like, why it's dominated by the smart money, why wave three is the longest. And again, I love the behavioral aspects of Elliott wave analysis much better than I like the specific measurement techniques that I find are less helpful for me. But I think those two books, if you check them out, will give you a good overview. Thanks for asking about that. I have yet to have a good Elliott wave strategist. That's not true. I've had Jeff Hughes on the podcast a couple times. I would love to bring on some others. It's on a long list of things I'm hoping to get to here at some point. I'll do it as soon as I can. Next question: is there a Zweig breadth thrust technical indicator that uses the simple moving average rather than the exponential moving average? Yeah, we talked about the Zweig breadth thrust when it fired not too long ago. I still have it on the main chart list that I host on Stock Charts. And down, actually, that's not true. I took it off of there and I put it over here. in a breadth indicators chart list. Anyone see? There it is. All right, Zweig breadth thrust. So this is an indicator that Marty Zweig sort of, created and certainly popularized, which is looking at breadth data, and then the version that Stock Charts uses, it's a 10-day exponential moving average of the raw breadth data, which is very, very noisy. Now, Marty Zweig's original work, and I've never met Marty Zweig or really could tell you anything about his, and I've known people who knew him and worked with him. But from what I was told, he actually originally designed it using simple averages, and that's how he actually created it. But exponential averages end up just doing better, and so there are a number. If you look up the Zweig breadth thrust, there's actually a couple different ways that people try to apply what he was actually coming up with in his own work. The version that I use uses an exponential moving average, and that's pretty common now. I mean, that's what I've seen most people use. So I've not seen a version that specifically uses a simple moving average, although you could easily do it. This chart, which I'll try to remember to put a link to in the on the show on YouTube, you could just change it from an exponential average to a simple average. It's not going to work with this, but you basically here, I'm just using an exponential average, make it a simple moving average. You could do the same analysis and see what happens. But that's why we use the exponential average. It just ended up working better. If Palantir did a 5-to-1 stock split, would the PE come down to 104? Yeah, I mentioned earlier. So the answer is no, but I'll tell you why, and I'll bring up Palantir. So on Stock Charts, I have the they call it the full quote, and it shows and Palantir currently with an absolutely astronomical PE ratio, and I've heard people justify that. I think that's insane, but I get it. Like, I understand, and it's and anytime you question valuations that high, it's, well, you don't understand the long term. And I just, when I started in the industry in 2000. The industry was full of people telling everyone, you don't understand, the valuations make a ton of sense, and eyeballs count. We don't need revenues. We just need a website and a business plan. That's even not really necessary. So it feels too much like my early days in the industry. But so if there was a split, which you have to remember, right? What does this actually mean when you have a PE of 565 or PE, whatever, right? And let's maybe take something a little less insane, right? So here's like United Healthcare, a PE of 12, okay? So what this is telling you is for every dollar that UNH earns, you're paying $12. And the idea is valuations are, there's never a PE of 1. That would be ridiculously low because the markets are a forward-looking mechanism. We're pricing down the road. So you're paying now for the projected earnings going forward, right? So there's a multiple that makes sense. That's how the stock market works. We're betting on growth, which has been the story of the equity markets in history. So what this actually is the price per share divided by the earnings per share, right? So the price is what over here, 291, and the earnings per share is 24. So that's a PE ratio of about 12. That's how the math works. Literally the price divided by the earnings. But both of those are per share. So a 5-to-1 stock split, you're basically splitting the shares. So every share is now worth 5 shares. So the price per share comes down by 5, but the earnings per share comes down by 5 as well, because it's the same earnings. You're just cutting down the number of shares. So a split doesn't change valuations. The PE ratio would be identical. It can certainly fluctuate going forward because maybe a lower price stock causes different supply and demand dynamics or whatever. But the actual moment of the split, both the numerator and the denominator are being cut by the same amount. So it literally keeps it the same. So stock splits are really, and again, I feel like in the days of fractional ownership, stock splits are kind of a cute sort of example. It's like an old school way that stocks would become less expensive so people could afford them kind of idea. I don't think that really is super relevant as much as it was before. Now that you can just go into Robinhood and buy $10 worth of any stock and they'll fill it for you with fractional ownership, but that's the idea. Last question. We have a record 8 questions today, but why not? In your S&P 500 rises from bearish to neutral, but will it last article. That was a Stock Charts article. if I remember right. The chart was shaded in yellow between 5,500 and 5,750. Yeah. This is the stoplight chart. So I think the article you're talking about, if we go to stock charts and go to articles, my blog is called The Mindful Investor. And if we scroll down a little bit, I remember that article. Here we go. There we go. From what? End of April. And the question was, how did you do this chart? This is the chart that I shared in here. Yeah, so this is that stoplight chart. So it's using a tool on the stock charts platform, which is called it's actually called Chart Notes, but it's really like an annotations tool. And so the way that you do it is you do click. Sorry, I just went through a bunch of it. So on a stock charts chart, you click on annotate. Go here to this shapes. I'm picking a rectangle, draw the rectangle. It's going to give you some crazy color. Go up here to the color, and you just want to make it a lot less opaque, right? You want to bring the transparency in. Other thing to note is like this, which would be like the thickness of the border. I usually keep it totally thin, and then that's the way you highlight like a range. It's a super fantastic way to think about support and resistance. I use that all the time. Arthur Hill showed me that years ago on stock charts. So this is basically just a series of those boxes, and I literally just made different colors and then made them lighter so you could see the price action behind them, and then put some blue lines between them to kind of separate it and give it a little more clarity. But that's how I would do it. What I love about technical analysis, I love about charts, they tell a story, right? They show you something. And as much as I could tell you, the S&P over 5,750, I think is good, and the S&P below 5,500 is bad, and anything in the middle is neutral. This visual tells that story beautifully, right? A picture tells 1,000 words, right? And I think with charts, that's the beauty of it. It visually represents some of the things that we're seeing, some of the things that we're expecting, and it gives you a very straightforward way of tracking the price action going forward. And that's one of a number of different tools, visual tools that I think are helpful to help you just visually, represent some of your insights and outlooks when you look at the chart. As we go on the show, I'll try to remember to incorporate more of those into the show so you can learn how to do some of them on your own. But for now, we'll call it a week. Thanks so much, everyone, for joining me here on Chart This with Dave Keller. It's a pleasure to do the show. I have a blast doing it. I hope you can pick up on that as we go. And I appreciate all your thoughtful questions. Saw some questions come in during the show today. We'll get those in the mailbag, hopefully answer them next week. Don't forget to check out our podcast interviews with Gary Antonacci, with Nick Raich, 2 really good interviews. And the webcast coming up next Wednesday. Go to marketmisbehavior.com/May 2025. Have an awesome weekend. It's Friday night pizza night here in the Keller household. I wish you all well. And remember, it's always a good time to own good charts. Take care, folks.